Welcome back to episode 5. I'm Jen Nicholson.
And I'm Blair Cook.
You kind of threw down the gauntlet yesterday with your "the balance sheet is better" sermon.
And today, you're going to delude our audience into thinking otherwise.
Well, you should know by now who is more often right in this partnership.
Stop distracting the audience and start telling us about the income statement.
Well, like you, I brought the Microsoft income statement along just to show our viewers what one looks like.
I'm already impressed.
The accounting equation for the income statement is even simpler than the balance sheet. Revenues minus expenses.
Simple is good, and I'll be the first to admit that the income statement is typically easier to grasp, at least intuitively.
Where the balance sheet represented balances at a point in time, say December 31st, the income statement represents the total amount of business activity over a period of time, say January 1st to December 31st. When revenue is higher than expenses, positive income results. That's what we like. This quantifies the amount of shareholder value created.
And that's all well and good if there's only one shareholder. But in the case of Microsoft, aren't there millions of shareholders?
Yes, and that is why it's important for the company to quantify the earnings per share. That is each common share's proportion of the total amount of net income. This is a much more meaningful number to a Microsoft shareholder.
Why so?
Because a shareholder can take that $1.48 and compare it to their investment in the company. So if shareholders paid $30 per share and the company made $1.48 per share in earnings last year, the notional return on investment is 5%.
But that's not entirely true because the shareholder probably didn't get that $1.48 in their genes, did they?
That's true. The $1.48 is an accounting version of shareholder value creation. There are other views of shareholder value that we will discuss in later episodes. These have to do with finance.
And I love finance.
I know you do. So I'll stop you right there.
Fair enough. So carry on with your discussion of the income statement. Talk a little bit more about revenue and expenses.
Revenue represents the sales earned by the business. Sometimes this is obvious. If you are a retailer, sales represent how much product you sold to a customer, like how many clothes you sold.
But it can get more complex, can't it?
Why do you always go trying to make things more complicated?
Because I think it's important to be realistic. A lot of businesses sell products or services that don't lend themselves nicely to a single transaction like your clothes retailer. For instance, Microsoft sells multi-year licenses. The revenue C report is not necessarily a direct reflection of how many licenses they sold during the period.
As usual, you are right. I can't believe I said that. Generally speaking, the amount reported as revenue represents the amount of sales activity incurred during the period, which may be different than how much cash flow was collected from customers.
Yeah, you'll need to look at the balance sheet and the accounts receivable to get a sense of that.
Hold it. You had your chance yesterday. Can it on the balance sheet talk.
My bad.
At this point, realize that the accountants have a lot of rules that need to be met before a company can recognize revenue so that a reader can rely on this number as a good indication of the level of earned sales.
Okay, fair enough. So tell me more about the expenses.
Expenses are obviously incurred to generate sales. Expenses relate to the cost of purchasing inventory, like clothes, the cost we pay our workers, the cost we pay for overheads, such as office rent.
So essentially the cost of operating the business, right?
You got it. Now there are a few costs, like interest on our debt and income taxes, that also get included, that aren't specifically related to operations, but they're still costs we have to cover nonetheless.
Okay, so I think in fairness to our audience, we should also explain that some expenses are cash and others aren't.
What is it with you? We're just trying to describe the income statement.
But you admit it's true, right?
Of course. What Blair is referring to is that expenses include both out-of-pocket expenses that get incurred and consumed every day, as well as expenses that represent the consumption of long-term assets as well.
Long-term assets like plant and equipment.
Exactly. The income statement reflects only 1 year of consumption of these long-term assets. We call this depreciation, and certainly a topic that we will get to in the not-so-distant future.
Did you bring another income statement for us to take a look at?
I did. Like yesterday, let me bring up Groupon's income statement.
Looks like the customers are getting more of a deal than the shareholders.
I agree. In the 4 years since IPO, here is a company that has managed to lose almost $1 billion. Not sure I want to invest in this story.
Me either.
So I think the income statement tells a more compelling story than the balance sheet.
And of course, I favor the balance sheet. So how are we going to break this tie?
Let's kick it over to you, our audience. Leave a comment and tell us whether you think the income statement or the balance sheet is more useful.
And that's all for today's discussion.
See you tomorrow.